Order types and when to use them while trading. Part 1. Market orders. A market order is best used when you're trying to enter or exit a position quickly and you aren't worried about getting a specific price. Every stock has a bid price and an ask price. The bid price is what someone's currently willing to buy the stock for, while the ask price is what they're willing to sell for. If you're a potential buyer and you want to start a position instantly, you would enter the trade as a market order. That market order would be executed at the existing ask price, and the reverse is true. If you're a potential seller and use a market order, you'd be filled at the bid price. There is one thing you need to be careful about when using market orders. And that's when you're trading illiquid stocks. These stocks tend to have wide ranges between the bid and ask price. If you're using a market order, you won't be filled at the last executed price. And that's the main price that shows up on your order types and when to use them. Part 2. Stop orders. Now you're probably familiar with this term from the sell side when people say to use a stop loss. But you can also use stop buy orders, and actually I use that pretty frequently. But let's cover from the sell side first. Say you already own a stock and you want to limit your downside risk. You can set a stop loss or a stop sell order below the current price of the stock. But if the price drops below your stop price, your order will convert to a market sell order, and your position will be sold at the existing bid price. If that confuses you, go back and watch part 1 where I go over bid and ask prices. Stop losses are a great way to manage risk and get yourself out of a trade before more damage is done. And this is key for consistent trading results. Now to the buy side. Say a stock that you're watching is trading between $90 and $100. It keeps bouncing back and forth between those prices. And you want to buy the stock once it breaks above $100. You would use a stop buy order and set the price at $100 or slightly above $100. Once the stock breaks $100, your order will convert to a market buy order, and you'll be filled at the existing ask price. Order types and when to use them while trading. Part 3. Limit orders. You would use a limit order when you're trying to buy a stock for a certain price or less. This is most commonly used if you're trying to add to or start a position on a stock that's pulling back. Say a stock that you want to own is trading at $115, but you're only willing to pay $100 for it. So you'd set your limit price at $100, and if the stock fell to that price or below, your order would be filled. But what if the stock gaps down overnight? Would my order still fill? So your order wouldn't fill during after hours or pre-market unless you specified that beforehand. But the next day, if the stock opens under your limit price still, your order will be filled. Now to the sell side. You would use a limit sell order to sell a position into strength. Say you own a stock at $100 and you want to sell for a profit of 10%. In that case, you'd set a limit sell order for $110. And if the stock keeps railing and hits 110, you're out with your profit. But if it doesn't hit 110, you're still holding your position. Follow for part 4. Order types and when to use them. Part 4. Stop limit orders. We covered stop orders in part 2, limit orders in part 3. This is a combination of those. So if you haven't heard of that terminology, go check those videos and then come back. First, let's go over the buy side. Stop limit order is typically used when you're trying to buy a stock that's breaking out of a condensed range. But maybe this is a volatile stock and you want to limit how much you're willing to pay for it. To set up this order, you need to specify both the stop price and a limit price. For example, say you're watching a stock that's trading at $97 and you want to buy it if it breaks over $100, but you want to limit your cost. You'd set your stop price at $100 and your limit price slightly above. Once the stock breaks over $100, your order will convert to a limit order. And as long as there's an existing ask price under your limit price, your order will be filled. But if the stock jumps over your limit price, you won't be filled until the stock price pulls back. The sell side is the same thing, just reversed. You have the current price, the stop price, and then the limit price. If the stock price drops below the stop price but still above the limit, your order will be filled. But if the price of the stock you're holding gaps down below both the stop and the limit price, your order won't be triggered. Follow for parts. And although this is the last segment of this series, we just started a new one on the characteristics of winning stocks. Trailing stops are similar to the stop orders that we covered in part 2. They're more commonly used from the sell side, so let's start there. A trailing stop order is used on a position that you currently have. With a trailing stop, you allow your stock to continue to run higher until it reverses, then you get stopped out. To set the order up, you need to decide on a dollar amount or percentage amount of your stop. This will be the max distance that the stock will pull back from its highest point before you get stopped out. Say you have a stock at $100 and you're using a $5 trailing stop. And before that stock ever pulls back $5, it goes up to $140. Once it reverses below $135, you'll be stopped out. This is a great way to manage risk but still lock in profit. Now from the buy side. Say a stock's been in a long-term downtrend and you're interested in buying once it reverses. Then you'll set the dollar or percent amount for your trailing stop. And if that stock reverses off the low by your stop amount, you'll start your position. It's like buying the dip, but only if it's a substantial move. Make sure you follow